Hi there, welcome to Kneppyinvests. The point of me doing videos like today is to share ideas with you, and hopefully if you like what you see, hear or read in this video, that can give you the impetus to further your research on these companies to see if these companies fit into your own investing strategy and your portfolio. The 5 companies I'll be looking at in today's video entered onto my radar over the past year, but they released some news in the past week. So I've done a little bit more research on these companies and I've put them onto my potential buy watch list. So I haven't taken a position in any of these companies. In fact, one of these companies I've been following for quite a few months and I've been wanting to take a position, and I'm almost at that point of buying into this company. So just because these companies might fit into my own investing strategy doesn't mean they will fit into your own investing strategy. That's up to you to decide. The whole point of this video, again, is to share ideas. So let's get to the first company, and that company is Image Resources. This company is a mineral sands mining company in production. They began production in December 2018 with one of the projects, which is 80 kilometers north of Perth. They also have 12 other projects as well. If you don't know anything about mineral sands, because mineral sands producers or mineral sands itself aren't really talked about in the mining community all that much. So they're not a really popular sort of mining company, but mineral sands tend to, or the companies I know, tend to give pretty good dividend yields. Like Image Resources have a dividend yield of 10.5%. But mineral sands themselves, zircon, rutile, ilmenite, tend to be used in everyday stuff. For instance, zircon, which turns into zirconium, is used for ceramic tiles, metal castings, and air and water purification. Rutile and ilmenite turn into titanium, and that's used for pigments for paper, paint and plastics, sunscreen, and also joint replacements. So you can just see mineral sands is used for everyday stuff. So we're going to be needing mineral sands for a long time. These companies aren't that sexy, and because they're not very sexy, market cap of Image Resources are only 187 million, yet they have revenue of 176 million, operating cash flow of 65 million. They also have a dividend, and the dividend yield for this company is 10.5%. I have another company in my portfolio called Base Resources. They're also in mineral sands, and they have a dividend yield about 10% as well. On the 20th of July, Image Resources released a preliminary June 2021 quarter update. They will release a cash flow report later in this month, hopefully, because they did release one for the March quarter. Production for the first half of 2021, 187,000 tons. Guidance was for the calendar year 21 between 290 and 320. So they're actually above guidance right now. They have $38 million of cash. That's after paying down all their debt. So they are debt free and have cash. So net cash at the moment. And they also gave out their inaugural dividend, which was 2 cents. They have about 1 billion shares on issue. So that 2 cents amounts to about $20 million. So because they are producing a lot of cash, they're able to pay out a dividend. And the other really good tailwind behind mineral sands companies is the price of ilmenite, zircon, and rutile are tracking higher. You can have a look at their presentation because they do give some graphs of the prices of those three in one of their presentations. Just want to go back to the March quarter because they did release a cash flow report in that quarter, so hopefully they will release one for the current quarter. Receipts and customers for that quarter was 50.7 million, and they were operational cash flow positive in the quarter by 18.3 million. And on the top right there, I've just gone to section 4 just to see what's happened with the cash on hand. So cash at the beginning of the quarter was 50.8 million, and by the end of the quarter it was still higher than the beginning, 51 million, even though they did pay down debt of 17.2 million. So they were able to pay down their debt through their operations. That's exactly what you want to see in this sort of company. They also spent about $1.1 million on exploration and evaluation. So this company is making money, and through the money they're making, they're paying down debt and they're paying dividends as well. This is the weekly chart for Image Resources going back to 2012. Between 2012 and beginning of 2017, share price of Image Resources was in a bit of a downtrend. They began production towards the end of 2018, and just before they began production, that's when the sentiment in this company shifted around and we started to see the share price track up. And during 2019, just after they began production, that was the best time to be in this company. Share price went from 10 cents to a high of 30 cents. We have seen the share price, they've been under a little bit of pressure since that high of 30 cents in the middle of 2019. No real discernible uptrend in the share price right now. That's one of the things that would be holding you back buying into this company. However, just because of a dividend yield of 10.5% right now could be a good income play for those who are looking for some income in their investments. The second company I want to talk about is LPE, or Locality Planning Energy. This is an electricity provider in Queensland. I'm not sure if they have expanded into other states just yet. When I went to the website, they're only talking about Queensland. They are getting a good market share, about 7% market share in Queensland at this point in time. A market cap of only $14.5 million, which seems a little bit low when you look at their announcement they released on July 20. Revenue $48 million in the trailing 12 months, and operational cash flow negative in that 12 months as well by -3. However, when they released their trading update and preliminary results for the financial year 21 on July 20, the market did take notice to this announcement. Share price increased by 30% on the one day. I also took notice. And the reason the market and I took notice to these results is because of some of the numbers they gave us. Revenue increased 27% from 42 million to 55 million. Gross profit increased 163% from 5.7 million to 14 million. EBITDA, which sometimes I use as a proxy for operating cash flow, it's not really good proxy, but it's the best rough proxy you can use if a company doesn't give you any operational cash flow numbers. I do prefer operational cash flow as a good guide to how a company is performing. In any case, EBITDA went from negative 3.2 million to 3.7 million positive, and profit went from negative 7.2 million to positive $1 million. So this company is now profitable. So before we look at the chart and see the effect of this announcement on the share price, let's just have a look at the receipts history for this company. This company does issue Appendix 4Cs every quarter, so we'll see how they've been doing on a quarterly basis. I have been following this company for quite a few years, in fact over 5 years, almost 6 years. And back then when I started following this company, receipts, so this is receipts history on a quarterly basis. Receipts going back to the December quarter in 2015 was only $190,000, and this company has been growing their receipts. And that's the main reason I have been following this company, simply because of this graph and a consistent growth in receipts through time. We saw a little bit of a blip during the COVID-19 financial panic and 2020. So we did see receipts go from 12 million to a low of 9.7. So there is a bit of lumpiness here, but generally receipts are going up. And that's a good sign that the company is growing. Just because the financial state of the company is improving, just see that with the cash receipts growing through time, doesn't mean the market will share the same thoughts with a company. And we can see with the chart of LPE, this is the weekly chart going back to the end of 2015, the market hasn't been enthusiastic about this company during this time period. In fact, the share price has gone down from $2.50 to a current share price of 24.5 cents. Now, back in 2016, the share price wasn't that high. This company has gone through a consolidation, maybe a 10 for 1 consolidation, that sort of thing. But the main thing to take away from this graph is the share price has been going down over the past 5 to 6 years. So you haven't really want to be holding this company through this period. What you want to do is wait for a shift in sentiment, a shift in the share price movement. And maybe we've seen that with the release of this financial update. The share price right now is at 24.5 cents. We've seen the share price drifting down over the past year. We've also seen an increase in volume. That's actually a good sign. The market is becoming interested as the share price has been drifting downward, and the share price on the release of this announcement moved towards the 50-week moving average. What will be useful over the next few weeks is the share price to consolidate around 25 cents or move upwards. If we get the share price moving upwards, this could be confirmation that there is a shift in sentiment in LPE and a potential new uptrend in the share price is developing. This is around about a 14-month daily chart for LPE, and really nothing to get excited about when you look at this chart. Share price has been drifting downwards, a little bit of volatility there just because there's not a lot of trading in this company's shares. When they release these preliminary results on July 20, share price actually did increase by 31%. At one point, the share price was as high as 34 cents, so that increase in the share price was a little bit higher. But at the close, the share price was only 24.5 cents. So a fair bit of selling came in to the market when they released these results. And one of the main reasons that there was a lot of selling is when the share price got to above 30 cents, there would have been a lot of buyers who bought into LPE over the past year at higher prices, say June, July of last year, when the share price was between about 31 and 37 cents, saw their opportunity to sell out at almost break even, and that's why there was a bit of selling pressure that came in to the market during that time period. Now, the next few trading days after they released these results, share price went sideways, a little bit of volatility there, but the most important thing here is we didn't see a lot of selling continue, and that's actually quite important. So potentially all those wanting to sell out because they bought in at a higher price in the previous year have had the opportunity and they've already sold out. So the share price might continue to move up from here or consolidate and go flat. I'll be keeping a close eye on LPE. Potentially, when they officially release their full year results, there could be a lot of excitement in that because a lot of people wait or even don't take notice to these sort of announcements. And when they release their full year results and the company is officially profitable, that's when the market could get excited again. So I'll potentially take a position in this company if I see the right market reaction in the next few weeks before they release their results. The third company I want to talk about is Prophecy. This is a computer software company. I do have a little bit of history with Prophecy. I bought into this company about 5 or 6 years ago when the share price was rising quite quickly, and then things just fell apart for this company, and you'll see that when I show you the weekly chart. Prophecy have two products, eMight and Snare. eMight is a service intelligence platform, and Snare is a set of event monitoring and analysis tools. Seems like eMight is where the growth in this business is happening, and Snare is sort of going backwards. But this company does look quite good value right now, with a market cap of $41 million, revenue of $12.6 million in the trailing 12 months, and operating cash flow positive, and more than likely they will be profitable in the last 12 months. On July 21st, they did release Q4 sales results, which did trigger a bit of excitement in the market. So we'll have a look at that when we see the chart. It all comes back to what's happening with eMight, not really with Snare. So eMight has grown quite quickly in the last 12 months. So they broke it down into Q4 and financial year 21. So Q4, comparing to the previous corresponding period in financial year 20, grew at 316%. In financial year 21, it grew at 32%. And the annual recurring revenue in eMight grew from 4.3 million to 7.6 million. That's a 77% growth. They also broke down Snare, and Snare actually has been going backwards, going down in Q4 from 2020 to 2021 from 1.53 million to 1.5, and in financial year 20 they were 6.8 million. Now it's 5.1 million. So Snare's going backward, and it seems like all the growth is in eMight, and group annual recurring revenue is at 11 million. I sometimes do a rough estimate of a fair valuation of a company when they provide annual recurring revenue. I simply multiply annual recurring revenue by 10, which gives me a potential rough estimation of the valuation of a company. So when you times prophecy's annual recurring revenue, you get a rough valuation of the company of $110 million. Current market cap's 41. So there is potential this company is completely undervalued at these valuations. Now that's a very rough estimation, and you don't take into account the growth rate in annual recurring revenue. But IMA grew their annual recurring revenue by 77%. So if they could continue that sort of growth rate in the next few years, their annual recurring revenue will grow significantly in the next few years, which would mean a market cap of $41 million for this company is really, really low. And it seems like the management agrees with me, because they had a little bit of commentary in the announcement, which said, as a result, we believe that the EMITE business is significantly undervalued by the market compared to other ASX listed SaaS growth businesses addressing the contact center market. So that's the reason I put this company back onto my watch list for a potential buy in the future. However, in saying all that, I am still a little bit wary, because when we look at the financial history of Prophecy going back 5 years, looking at the revenue and operational cash flow broken down into half-year increments, we don't see any growth during this time period. But of course, just because this has happened in the past doesn't mean that will continue for the future. And you have to be very careful that you don't look at the previous growth rates in a company and try to think that's going to continue in the future. What we're now seeing is this company is potentially turning around simply because of the EMITE and recurring revenue growth. And if you are a bit of a risk taker, and sometimes I am, taking a position in a company when you do see some good value, like potentially there is with Prophecy, right now could be a good time to buy into this company. But you do have to be mindful that just because EMITE has been growing over the past year at a really good clip, doesn't mean that will continue for the future. So a lot of things, a lot of risk around this company right now, a lot of things to be wary about. If I was a risk-averse investor, I'd probably just wait to see if this growth in EMITE can continue before I take a position. And in that case, you do have to be mindful that the market value of this company could explode in the meantime. So it could go from 41 million to over 100 million if they can continue this growth rate in EMITE. I'm going to look at two charts for Prophecy, the weekly chart and then the daily chart. The weekly chart goes all the way back to 2014. I just wanted to include 2015 and then 16 in this chart just because you can see what happened with the share price during that period. A lot of excitement came into the market with Prophecy. Share price in 2015, share price went from about 35 cents all the way to a high of $2.50. And then the share price fell off a cliff in 2016 and towards 2017. Went from $2.50 and went to a low of 25 cents in 2019. And since that low of 25 cents, the share price really hasn't done anything. We did see the share price get to a high of about 90 cents just prior to the COVID-19 financial panic, fell off a cliff, recovered quite quickly, and went back up to the high of 90 cents just after COVID-19. And that was sort of a double top, it seems like, because the share price has been going sort of slightly or slowly downwards since then. However, with the release of this Q4 sales update, it did trigger a bit of excitement in the market, and you'll be able to see that excitement when we look at the daily chart. With the daily chart of Prophecy, I just wanted to include the double top we did see when the share price reached 90 cents just before COVID-19 financial panic, and then just after the COVID-19 financial panic. And in between the share price reaching 90 cents, the share price fell all the way down to about 25 cents in the heights or the depths of the COVID-19 financial panic, probably on March the 23rd. So you can just see the recovery, the V-shaped recovery in the share price just with Prophecy. Ever since that high of 90 cents that was reached towards the end of, it was the start of July, the share price has been drifting very slowly downwards. A little bit of volatility with the share price of Prophecy. But when they released their Q4 sales results on the 21st of July, there was a little bit of excitement in the market. Share price rose 8% on the 21st, and then a further 9% on the 22nd. I really like to see that share price action on the next day after the results have, or not the results, the announcement has been released. That shows you there's not a lot of selling in the market, even though share price did rise the previous day. However, in saying all that, the share price right now is around 65 cents. And if you go back through the past year, the share price has been around these levels and higher for a fair bit of time. So there should be a little bit of selling pressure as the share price moves higher, because all those people who bought in the previous year at higher share price will see the opportunity to sell out and at break-even levels. So keep that in the back of your mind if you are thinking of taking a position in this company. I think the share price moving higher is going to be a slow slog in the next few months, if it does happen at all. The fourth company I want to talk about is Paygroup. This is a company I've been thinking about buying for the longest time. Ticker code PYG. This is, well, Paygroup offer software with a service and software as a service based platforms in human capital management, or the way I like to say it, just human resources. They are the holding company of 4 other companies: PayAsia, ST1, Talentos, and Payroll HQ. On July the 22nd, they did release financial year 22 guidance and quarterly business update. Now, the reason they're releasing financial year 22 guidance is because their financial year 21 finished in, I think it would have been March of this year. So they're already into financial year 22 right now. This company is growing their revenue, is operational cash flow positive. They don't have to issue any more Appendix 4Cs. They were told that by the ASX in the March quarter because they released 4 quarters of operational cash flow positiveness. And the other thing is the annual recurring revenue is growing at a fairly good rate. And they provided that in the announcement on the bottom here. So I provided that as well. Financial year 22 annual recurring revenue is expected to be between 35 and 37 million. And just remember, with prophecy, what I tend to do is just multiply annual recurring revenue by 10 to give a rough estimate of a fair valuation in these sort of companies. So that gives a rough estimation of Paygroup of between 350 and 370 million. And I also said that's not taking into account the growth rate in annual recurring revenue. And on the bottom there, they do give a growth rate in their annual recurring revenue. In fact, it's been growing at between 61 and 64% per year since financial year 19. So it's gone from 8.4 million, 17.8 million, 27.2 million to between 35 and 37 million. So this company is good value right now. And that's the main reason I've been thinking about taking a position in Paygroup. There is one thing that is holding me back, however, and we'll look at the charts for that reason. They also received $4.6 million in new contracts during the first quarter, and they had $12.5 million of cash at the 30th of June, which means the enterprise value right now is $50 million. That makes this company even more attractive at these prices. So let's look at the one thing that has been holding me back from taking a position in this company. Actually, before we get there, just want to look at the financial history of Paygroup. So again, this is just the revenue and cash flow from operations over the last 4 or 5 years, again broken down in 2 half-year increments. And unlike prophecy, there was very little growth, if any at all, we are seeing growth in revenue through this period, and they are operational cash flow positive through this period as well. So really nothing to be too concerned with Paygroup when you look at their financial history over the past 5 years. Now on to the one thing that's been holding you back taking a position in Paygroup. This is the daily chart going back to, again, just prior or around the COVID-19 financial panic. And there is no discernible uptrend with Paygroup's share price. In fact, even though I've been wanting to take a position during this time period, I've seen no reason simply because of the lack of interest in the market around this company. We did see, however, potential interest come into Paygroup towards the end of May, start of June, when the share price got to a low of 44 cents. We saw a massive increase in volume. So I think there were potential some fund managers who saw some good value in this company. And since that time, we have seen the share price starting to trend higher. And when they released this announcement, the share price move towards 53, 54 cents. So there is potential new uptrend developing. But again, because the share price has been significantly higher in the past year, I think there's going to be a lot of resistance as the share price moves higher, as a lot of shareholders who bought in the previous year at higher share prices see their opportunity to sell out of this dog stock, even though it really isn't a dog stock. But the psychology of the investor is if you buy into a company and the share price falls, it automatically becomes a dog stock and you want to sell out of that company as soon as the share price gets back to the share price you bought in. So there's a lot of resistance moving forward for this company. So I think it does, or it can be prudent to remain patient with this company. What I'm thinking of doing is to buy a small holding in this company, say 2,000, 3,000, actually about 4,000 shares as a small holding, and then build on that holding if the share price actually does move into an uptrend, or there's some more good financial news being released by this company. Because right now, I do think this company is really good value at a share price of 53 cents. The final company I want to look at, Spirit, is not a company I've done much research in the past. In fact, when I started my research on this company in the past week, I actually called them Sprint, and I actually Googled Sprint, and then I realized they're called Spirit. Ticker code ST1, market cap 205 million. Probably should say what they do first. They are a telecommunications company, developed their own fixed wireless network, and it seems like the speeds they can get on their network is quite high. They also have a managed IT services. They released their financial year 21 trading update on July 20 and also gave financial year 22 guidance, which I find interesting. And if they can hit their guidance, this company is growing very quickly. Financial year 21 revenue, 104.5 million, which is a 200% increase on the previous corresponding period. EBITDA, 11.5 million, a 208% increase on previous corresponding period. Sometimes I use EBITDA as a proxy for operational cash flow. It's a rough proxy, but most companies don't give operating cash flow guidance. I wish they would, but usually don't. Annual recurring revenue, 27.2 million. That's a 33% increase on the previous half year. And their financial year 22 guidance, so much higher. Revenue of 150 to 155 million. That's almost a 45% increase. Underlying EBITDA towards $20 million, which is a 68 to 75% increase. So this company is growing very quickly, and potentially their share price right now could be good value, because with an annual recurring revenue of 27.2 million, using my 10 times multiplication factor, this could be undervalued, particularly when the company is growing quite strongly. And when I look at their financial history going back to 2015, I'm not sure why I haven't done any research in this company. I think there's more than likely they would have done quite a few acquisitions to get this growth rate, because if this is all organic growth, this company is performing outstandingly. So they've exceptionally grown their revenue in the past few years, going from 9 million to 42.8 million and expecting 155 million in financial year 22. Operational cash flow haven't grown quite as strongly, and that's falling behind a little bit, but more than likely they're spending a lot of money to grow. So I'm not sure why I haven't done any research in this company when you look at this table, and the growth in revenue has been quite substantial in the past few years. And the last thing I want to show in this video is the daily chart for Spirit, going back to just about the COVID-19 financial panic. When the share price of Spirit got down to 12.5 cents, we saw the share price just explode just after the panic. So between May and September of 2020, share price went from about 12.5 cents to a high of 45 cents. And never since that high of 45 cents, we did see share price go sideways. It reached 45 cents twice after that, in around December and then January of this year. And that seems like it's a triple top. And usually when you see a triple top, share price will fall back. And we actually saw that. and looked like the share price was under a little bit of pressure over the past few months. In fact, the share price went from that high of 45 cents, went all the way down to a low of 25 cents. But a little bit of excitement has come into the share price over the past few weeks, and the share price right now is at 32 cents. Just like a lot of other companies I've featured in this video, there's going to be a lot of resistance moving forward with Spirit's share price because of all those shareholders who have bought at higher prices in the previous year. It's all about human psychology, but if we do see the share price of this company moving into a nice looking uptrend, this could be a good time to take a position in this company simply because of the growth rate, and the share price or the valuation of this company is not too high based off what we see with their financial state. That is all I have for this video of 5 ASX stocks that I am now starting to follow a little bit more closely, because I do think there is some good value with some of these companies, if not all of them. However, there is a bit of risk just because a lot of resistance with the share price moving forward because of human psychology. If you do have any questions or comments about these 5 companies I've featured in this video, make sure you leave a comment or a question in the comment section. I'll answer anything you have to say in the next few days or weeks. I am on leave for 6 weeks right now. It was a strategic leave period because it covers the end of the Appendix 4C month, which is July, and it covers most of August, which is reporting season. So hopefully I'll do a fair few videos in the next 5 weeks to cover all the interesting financial reporting that will be happening during that period. That's it for this video. Probably the last thing I should say is I'm not a financial advisor. If you do need financial advice, make sure you seek out someone who is qualified and can speak to your own financial needs. That's it for this video. Have a great weekend. Talk to you later. Bye. Or in fact, the weekend's almost over if you're watching this video, because I shall be releasing this at the end of Sunday. So I hope you've had a great weekend. So that's it for this video. Have a good day. Bye.